If you're getting started in this space, it's always that chicken or egg conversation, right? Do you get the investors first or do you get the deal first, right?
Or both
And
of them at the same
you
time.
have to, yeah. I think on the investment side, you're not getting a commitment on something, but you're teeing up investors and letting them know what you're doing, and it's a process. Hey, this is who I am and my experience. This is what I'm working on and for focusing on. This is what I'm looking to do, and finding those investors that are aligned with your interests, with that risk profile, that believe in you as an operator. And so having those folks, keeping them close, staying in touch, this is really critical. And I think actually you could form some of the closest and tightest relationships in that early side. There's a lot of investors who appreciate that.
Welcome to Breaking Ground Commercial Real Estate Podcast, the show where big ideas meet real opportunities. Here you'll find conversations that inspire, educate, and empower, whether it's turning dreams into reality, building smarter investments, or finding the right space for your vision. We cut through the noise and share strategies, stories, and tools that you can actually use. Welcome. My name is Kenya Sanchez. I'm a commercial real estate agent, and I love to help people bring their dreams into reality into a space they can do their business in.
And hello, everyone. My name is Tao Nguyen. I help the investor build generational wealth through real estate investment.
Well, most people in real estate think that a deal is about location or rent or tenants. But the truth is, the deal only happens if the capital says yes. We can have the perfect location, the right tenant, a strong lease, but if capital doesn't back it up, the deal doesn't happen. And today we're pulling back the curtain on that side of the business, and we have our guest, Drew Wahlgren. Wahlgren, sorry about that. Can you tell us a little bit about yourself and what you do?
Sure. Yeah, my name is Drew Wahlgren. I'm the VP of Capital Markets here at MAG Capital Partners. We're a private equity investment firm focused on industrial real estate and industrial operating companies. So my role here is primarily raising equity for investments. Not only do we manage funds, but we also structure SPVs, single asset investments. And so as we move forward with those investments, I'm lining up the equity to partner with us and close on these investments.
Okay.
Well, one thing is we might look at the same deal and we're thinking about a tenant, rent, and operations. That's what we focus on. And you're looking at risk, return, capital. So, how does that look? Let's break that down together.
Yeah, well, I mean, really, there's so many investment classes and strategies. I'll give a little context here. We're primarily focused on single tenant industrial real estate. We're primarily buying these properties through sale leaseback transactions. So we're buying these properties from an owner user, typically a manufacturing company, a food producer, and simultaneously buying from them and leasing it back so they continue operations there. So the way we look at risk in those investments is primarily the credit of the tenant,
Mhm.
because these are typically 20-year leases that are absolute net in terms. So we're totally insulated from operational expenses. However, the risk is you have a binary rent, right? You're either 100% occupied and collecting rent, or you're not at all because you have a single tenant. So we're really looking at default risk or vacancy risk. Um, what are what's the risk of this tenant not being able to, stand up to their rent
Yeah.
obligations, to be, financially solvent enough to manage the property and pay their rent obligations. So that's really what we're looking at primarily. Now, when you start looking at all the investment classes, you have to look at each individually and a little more uniquely, right? Multifamily risk is far more market dependent than what we're doing, for instance, right? Because you often see these industrial manufacturing operations that are in the outskirts of town. They don't need to be in a neighborhood with good schools, right? This is not something that manufacturers care about. They need a facility that has access to labor, transportation. They need a building that suits their needs. Typically, these buildings are open floor plans, and so there might be a few little needs there, but as far as location goes, way less important for them and way less important for us as well. In that case, relative to something like multifamily or retail, right? Retail and real estate is highly dependent on foot traffic and the surrounding submarkets, income, demographics, all of that. So, anyway, it's a broad question how you look at risk, but I spoke a little bit about how we do in our investment strategy. And that's where we dive in really deep, and we've kind of built our team around that with credit analysts that we've brought on, which is a little unusual for a real estate shop to have corporate credit analysts to be part of your team and dive deep.
That's
But
awesome.
that's where we're primarily focused. So it's we've invested into our own team and grown that side.
I did want to ask a little bit about your background. How did you get here? How did you start this?
Sure. Well, I'll try to keep it brief as I can. I'll go way back. I was an entrepreneur when I was 20. A friend of and I were running a guy's beverage and food distribution company, and we had the opportunity to buy it from him, and we did, and I did that for some years. And 2008 happened. A lot of my customers were boarded up, out of business, and so we didn't lose money actually, but we tried to sell the business. No one would buy it. No one had cash. Everyone was, in an extreme state of fear during the financial crisis. So I ended up just liquidating the inventory we had. I was 20 when we first bought this, so I went back
Wow.
and finished my business degree as an emphasis in finance. And then actually went into the corporate world for a while, had Liberty Mutual Insurance. But during that time, I was buying some real estate in the Bay Area where I lived, single family homes, and I fixed them up myself and flipped the first one and did well in that, but mostly was getting a lot of luck. I started about 2011. So the market was really kind of at its bottom there and starting to recover from there. And so I did that several times and did well. But I didn't want to do this professionally. I was seeing opportunity at the corporate career that I had. I wanted to focus on that. Years go by, I get married, start having kids. Anyway, I wanted to invest in real estate, but passively. And my brother introduced me to this world. He was in this industry, and he actually introduced me to several operators, one of which being Mag Capital Partners. That was in 2016. I started to invest as a limited partner and got to know the principals here at Mac. And fast forward a few years later, I was ready for a change, and my brother was too. He was at a commercial real estate investment shop, and so we formed our own shop for a moment and said, "Hey, we can raise equity in partnership with good operators, trustworthy operators." And Mac Capital Partners is one of those. We both had a lot of experience with them, and so we were in partnership on one deal together, and right after that we said, hey, this makes sense to scale this, and we'll put aside our own name here, Wahlgren Capital Partners, which we had for a short moment, and join the Mag Capital Partners team because we said, hey, we can continue to scale this and help what is a group of fantastic operators, but didn't really have that capital machine to support more investment, growth. They had started with family and friends, as many do. And ultimately, that network started to tap out and say, hey, you have all of our money in these investments. I wish I had more to give you. Right. But I don't, so you do have to grow that base over time. And so my brother and I came on board and said, hey, we can build this out for you. We can manage this. We can really become vertically integrated versus partnering with someone else who can bring the equity. So that was,
Great.
a very good, that's been a great ride since then. We've really built it out. Today we have about 1.5 billion in assets under management, about 400 million or so in investors' capital that we manage. So, that would have been hard for me to believe in 2019 that, in 2026 that would be the case, but it's been a great ride.
That's great.
Okay. So when we bring you a deal, what are the top three things that you will look at?
For what kind of deal? An industrial deal?
Industrial deal. Let's do it that way.
Yeah, it happens all the time. People say, "Hey, I think we have a potential deal that you guys would be interested that would fit your criteria." And the first thing we're really looking at is, okay, if we're doing a sale leaseback with a group of an industrial property, who's the group? Who's going to be our tenant, right? They're just going to sell, but they're now going to be our tenant,
Yeah.
right? So that's the most important piece there. What are we talking about? Oh, it's a new operation that, they just started last year. They're making a little revenue. They're not profitable yet. They're scaling up. That's not really a deal we want to do. On the other end of the spectrum, it might be, hey, this is a Fortune 100 company and their investment grade credit. It's probably not going to be a deal for us, not because we don't like them, but because the cap rate is going to trade at such a compressed rate. This is going to be a very safe, very low risk deal that's going to trade and frankly offer a very low yield. And so it's just not something we want to do on that end. That's going to be an institutional group who says, yeah, we're happy to buy this at a 4.9% cap rate, right? If it's Amazon behind the lease, right? That's virtually no risk. And they're going to get maybe a hair over treasury yields because it's about that risk profile. They'll get tax benefits, of course, being in real estate, but that's not something we want. We want higher yield than that. So we're going to fall in between those two kind of extremes there. And so we're going to be wanting a privately held company because typically we can get a little better yield there, but then we can dive into the financials and say, hey, they're not they're not credit rated, they're not publicly traded. Okay, there's a little more of a perception of risk, and that is an opportunity for us to come in and spread the financials, talk to the management team, and evaluate that risk profile ourselves. But behind that, it's going to be, yeah, what's the real estate? What's the size of the deal? I sometimes have to get our acquisitions team to stay away from deals that are a little too small. We have a team of 30, right? There's a lot of mouths to feed. It doesn't make sense for us to spin our wheels on a $3.5 million transaction, right? You got a lot of people involved. You got a lot of structuring. You know, um, it's too much work for, frankly, not enough we do pay the bills with management fees. A little bit on the front end as we structure these, we'll take an acquisition fee, but all that's based usually on the size of the deal or how much equity is involved, right? So, we want to be in a good space, but not too big, right? So, I mean, I typically tell people when they're asking, I say, look, we can we can strike $10 to $30 million every day. We can go a little lower than that. We can go higher than that. If you want to go higher than that, we can go 40, 50. If you want to go really big, we're going to need more time because we're going to really need to see some bigger equity partners and be able to ensure that we have them there. But between 10 and 30 million, we can rely on the existing investment partners and frankly feel confident that, hey, they'll be there for us. And I think we're going to talk about that in a minute, how you know that they'll be there for you. But within that range, I mean, we do that repeatedly all year long. And then behind that, of course, location, right? And it's really for us, it's a relationship between credit risk, yield, the real estate basis, right? How much are we paying per foot, the market that it's in, and sort of understanding, all those factors and how they relate to each other. And again, that yield being a big part of it too, right? If we're taking a little more risk, we're a little more tertiary, a little smaller of a credit on the tenant. Are we getting compensated for that? And we're willing to go into a little bit more of a smaller credit or tertiary area, but the yield needs to be there, right? So it needs to be commensurate with that risk. And so all that's going to be looked at.
For sure. For sure.
Well, we have many people that work with, that we work with are small business owners, salons, restaurants. What are some of the common mistakes that you see that when they try to step into commercial real estate investment? What do you think that they could improve on?
A small business owner?
Yes, as a small business owner.
Yeah, I see this all the time. I work with a lot of investors who sell their business, right? They come to a capital event, and oftentimes maybe there's an employment agreement for a year, 2, 3 years, whatever that is for the new ownership, but they have a capital. So they see this decrease in their income and then this large increase in their cash position. They want to deploy that. They want to replace their income, and so oftentimes I see people kind of wanting to jump in and say, I'm going to do it myself, it's probably just coming from that entrepreneurial spirit, saying, hey, I figured this business out. I can figure this real estate thing out myself as well. And it takes a lot of time, just like a business does, right? The 10,000 hours to master something. So, um, and oftentimes the mistake that people don't realize is how cumbersome and the needs are of a lender. Real estate investors are always using leverage, almost always, and that's one of the attractive features of real estate investing is using that leverage. But now you need to go and to that bank or credit union, private lender, and they're going to have they're going to go through all of your financials, and if you have a messy financial picture, that could be an issue, or maybe you're not prepared to sign recourse on that debt. I think a lot of folks are just assuming they'll get non-recourse debt. They might be able to, might not, but usually the leverage is better, the terms are better. Um, then that comes with recourse. So if you're not prepared to do that and understand what that process is, I see a lot of people spend a lot of time and they get to that point to go, oh, I actually, I want to get $7 million in real estate debt, and I'm not even going to qualify for it, or the terms are so bad because my qualifications aren't that strong, my credit isn't that strong. Then now this doesn't make sense. So they don't understand kind of what they're getting into, and then oftentimes maybe they do a transaction, and then a couple of years later they're managing a multifamily property or managing the manager of that and saying, this is a huge headache, and I was hoping to have a passive real estate investment, and it's just frankly not, right? um, Actually, what we do in the net lease space, is about as close as you come to being passive as you can, but there's still some management there. And I could tell you what we do. There's a lot of work up front in those sale leasebacks, but afterwards we're actually monitoring the credit of those tenants. And again, with the help of a whole credit advisory team, we're looking at them quarterly. We require that in our leases. So, does someone who owned a small business have some experience in that? Do they know what that risk level is? Can they understand? Maybe they do as a business owner. It really just depends on the individual, but they may say, hey, you pulled on your lines of credit, what's going on there? Or maybe your lender, this is your tenant we're talking about, you're looking at their financials and you go, hey, your lender switched you from interest only to amortized payments. Why is that? They don't have any faith in you anymore. What's going on, right? So anyway, some of those things that can come up where you start asking questions and learning more. And I find that a lot of people in the single tenant industrial space are very real estate focused, and they don't understand the credit. They sometimes don't care very much about the credit. They say, well, I have a great property. If they punch out, then I'm going to have, I'll be able to release this very quickly because it's a good property and I bought it at a good basis. Maybe that's the case, but maybe they're not prepared for, the time it might take, the investment it may take to do that, right? It might take 6, 9, 12 months. It may take a lot of TI dollars to put into that property to entice a new tenant to come in. So anyway, there's a lot of that comes with the territory if you don't have that experience. And a lot of these people invest with us, right? They understand that already and say, hey, I'm going to leverage your experience, Mad Capital Partners. You understand the space very well. You've shown a track record of success. I'm happy to pay you a management fee, and based on success, we're going to earn a promote, right? That's that incentive award, if you will, right? We typically will split 80-20 profits, 80% going to investors. So a lot of those folks are smart enough to understand that and say, hey, I'm gonna put my capital with an experienced operator, leverage their experience, and not have to manage the property.
Leverage the experience is important.
When we bring you a deal to someone on your side, what makes it something serious investor would actually move forward versus something that stay at the small investor level? Is
Um,
the same similar things that you already talked about and
yeah,
showed us about, but is there any other significantly that's different from the serious, very big serious investor versus entrepreneur, newbie investors?
yeah. I mean, I think some of it's going to come to risk tolerance. I think the larger you get, you say serious investor. I mean, we're a middle market real estate group. We close on anywhere from, $200 to $300 million a year in acquisitions. So I'd say, we're a serious group, but we're small in comparison to some of the institutional groups out there, right? I mean, you get publicly traded REITs, you have, JP Morgan as a net lease team, Angela Gordon out there, Morgan Stanley as a net lease team. These are, much larger than we are. But they still have some tolerance to risk, but I think groups like us are just going to be a little bit more picky within our criteria that we're looking for. And so we just see a lot of opportunity. Some of that just comes with the reputation within the brokers that are controlling a lot of that deal flow. And so, there's over 1,000 deals we look at a year, right? So you're looking at a huge amount. So you start to think, do you want to stretch to try to fit a square peg in a round hole, right? And we don't. And I think a lot of the larger, more serious institutional groups are like that, where an individual just may not have that much deal flow, and they may say, "Hey, I'm gonna work through this thing and get creative," right? And that might be their secret sauce, right? That might be how they create a lot of opportunity, by getting creative and making something work that's kind of difficult in the beginning. So there's a little of that, and you know, I I'll leave it there.
Like I could tell you a lot more with that one, right? There's a
Yeah.
lot more to that. Well, we've seen more activity around the multi-tenant industrial. What do you think is really driving that shift?
Yeah, and I didn't talk about this, but I talked about our focus on single tenant industrial real estate. But about a year and a half ago, we stood up a platform within, under the MAG umbrella called Sword Industrial Partners. So we've been investing in this multi-tenant industrial space for the last 18 months or so actively. The partners at our firm had owned some on their own, and that we've still managed today and didn't syndicate, but now we're a little more focused and brought in some team members to really um, drive deal flow and underwriting, and myself and the rest of our capital markets team get involved on those. As soon as we have something locked up in contract, we get to work on raising the equity for those. But it's a really attractive space, and the reason is we've seen over the last, really going back 10 years, but especially the last 5 or 6, you have, after COVID, this huge investment into large format industrial real estate to support a lot of logistics, mostly, actually.
Yeah.
That's not a space that we're super involved in. We like the manufacturing space, but huge amount of investment in there and development. And it's really been to support e-commerce, right? Everyone was staying at home for a while, and we needed last mile delivery. We needed a huge network hub and spoke system to be able to get a massive amount of products to people's front doors. And so there's a lot of investment there, and there continues to have been. And meanwhile, the small bay industrial, which is typically tenanted by, local businesses, service companies, commercial electricians, or plumbers, a lot of these guys that need, 10, 20, 30,000 square feet have been kind of, they're an afterthought, or they just haven't been thought of very much. And so that product really hasn't been built much in the last 5, 6 years. So there's this big supply demand imbalance there. Rents have moved quite a bit in all these markets, and that's even supported by the lack of supply there as well. So you have, what we see out there is a lot of these properties that have leases coming to term, very soon, in a market where rents have moved a massive amount in the last 5 years since that tenant was signed up, right? So there's a huge amount of opportunity to bring those leases up to markets. And then, there are some development opportunities as well. We closed on a property a few months ago in Tulsa, and there's a piece of vacant land, or part of the lot there, but we're going to develop that and expand there. And there's a huge amount of tenants that are searching, that we're talking to, that are dying for some space. And so the fundamentals are really there. We're pretty selective there on the locations. Again, you get a manufacturing facility. Does it need to be in the center of town on Main and Main? Probably not,
Hmm.
right? But these guys are typically, again, service-based businesses. They need to be a little bit more central, and frankly, there's more leasing risk, because it's not a 20-year lease like we have in the manufacturing side. These are 3 to 5, sometimes 10-year leases, but oftentimes 3 to 5 years. And so you go, look, you want to be, in an infill location that's going to be attractive to a larger, wider group of potential tenants. So you may have some turnover, Frankly, we haven't seen much. As these have come up to term on their leases, people are resigning at higher rents because, frankly, where are they going to go?
Yeah.
Right? There's not a lot of space available, and they can move somewhere else, and they're going to pay market rents there as well. So we're a little more, it's a little more location critical, and we've been investing mostly in the western half of the U.S. In markets like Tulsa, Sacramento, a lot in Phoenix that we've done, and so we're pretty careful on where we're doing those.
Okay. And then there's a cost to moving, so.
Yeah, absolutely.
Okay. How do we go from just finding the deals and to actually working with the investors and getting them funded? And what is the fastest way to do so?
If you're getting started in this space, it's always that chicken or egg conversation, right? Do you get the investors first, or do you get the deal first, right?
Or both
And
of them at the same time?
you have to, yeah. I think on the investment side, you're not getting a commitment on something, but you're teeing up investors and letting them know what you're doing, and it's a process. Hey, this is who I am and my experience. This is what I'm working on and or focusing on. This is what I'm looking to do, and finding those investors that are aligned with your interests, with that risk profile, that believe in you as an operator. And so having those folks, keeping them close, staying in touch, this is really critical. And I think actually you could form some of the closest and tightest relationships in that early side. There's a lot of investors who appreciate that. Hey, I'm an important investor to this operator, right? And it may take longer for them to get over that trust curve, but if they're over that, they know you and trust you and like you. That's a really nice thing for them to have, because they say, hey, I can have some input here, and I'm a very important partner to this operator. And I think a lot of investors like that, right? So just building those relationships, and a lot of people don't understand what to do there, right? How do I start? How do I find the investors? It's a whole nother topic, right? But on the deal side, yeah, I mean, at a certain point, you're gonna go out there, you're gonna make offers, you're gonna make a lot. You're gonna get blown out of the water, and you're not gonna chase them. You're gonna have someone you gotta grind through. It's just a lot of back and forth with the seller. But once you are there, once you're even under LOI, I will start to create materials for our investors. And then really once it's under contract, that's usually that time where we go, okay, time to pick this up and really start to formalize it. Um, get the materials that I've been prepping out to my investors, start to have those conversations, host a webinar for people to come in and ask questions and all that, and start working towards, our legal team start working towards having documents ready for them, shortly after that. So yeah, there's a little bit of a process, and some people, I'm sure many don't do it like we do, but you do kind of have to start as early as you can, and sometimes even before it's under contract. I mean, I'll start to share more details with investors, and especially the higher ticket investors, right? They'll typically want more time. Whereas someone writing a $75,000 check may say, be able to look at it, make a decision within a day or two. And so it's not a huge deal to be, talking to them maybe 2 weeks before closing, right? They say, okay, let me look at this, evaluate it. I have capital to invest. Sure. Someone who's writing $1 million, $5 million check typically will want more time. If they're an institutional group, they'll have partners, a committee, other stakeholders, right? It might be a pension fund, right? And they're responsible for the retired firefighters, if that's a firefighter's pension fund. So yeah, there's a lot of other stakeholders, there's committees and the process there that could take longer, and so you want to really be able to give them as much time as possible, because a lot of those guys, if you say we're closing in 30 days, they'll say that's too fast for us,
What
right?
is the typical time frame?
For groups like those,
Mhm.
at least 60 days.
Okay.
Yeah, and some will want 90 or 120 days. Honestly, 120 days is too long for us to work with them either, because frankly, things are still firming up, right? I mean, as soon as you're under contract, I mean, now you're pushing forward with loan term sheets and moving the lender towards committee approval on their side and loan documents. So there's a lot there that's not totally firmed up. You can try to start these conversations early, and I know some assets will have a little longer lead time. Many times we just don't have that luxury. We go, look, the seller needs to get this closed in a certain amount of time. In a way, we're serving them as well as our investors, but in a sale leaseback, which many of these investments for us are, oftentimes there's a time need. Sometimes we're meeting at the closing table when a private equity group is buying a manufacturing company and saying, "Hey, Mag Capital Partners, we want you to show up at the closing table as well and do this sale leaseback simultaneous to our transaction, so we never have to tie up any money in the real estate. We just want the business portion." So there's a $50 million transaction, 20 of that is real estate. So we'll show up, take that $20 million off their hands so they can lower their basis and not be parking capital in real estate, which is not where a private equity group wants to be investing anyway. Their expertise is in operating businesses and growing them. So in that case, you have a really time sensitive seller, right? Hey, we're closing. We are a smaller part of a larger transaction there, right? So we have to show up there, and if you don't, if you can't execute, then you have egg on your face, and you're not going to get a call on the next opportunity. So that's where we built a lot of reputations, being able to show up, being able to execute, no excuses, and making the deal work. Of course, the deal, still has to pass muster with us, but all that being said, we can't come and say, sorry, our financing didn't work out. Sorry, I had a family office and they were considering it for the last 60 days and then they said no. So now you think about that on the capital side and you go, okay, I have to have a very resilient, very robust investor group to be able to do that reliably. And so that's kind of an art more than a skill, I think, almost.
Yes, definitely.
And anyway, that's we're competing with groups that sometimes public REIT, they're just drawing a line from their balance sheet to close on this, so the capital is there, but they may have more layers of committees and stakeholders on their own side
Yeah.
that say, "Hey, sorry, I went to a final committee and it didn't get approved."
Yeah. Oof. Well, what if you were starting fresh here in the DFW? What would you recommend for the first year to start getting deals funded?
As a commercial real estate investor
Yes.
who wants to bring in outside equity,
Yes.
okay. Well, I'd start joining as many groups as you can, go to as many conferences as you can, and just start meeting as many people as possible. Because again, you have to start with those earlier conversations, right? When I have that investment lined up, who am I calling? And if you don't have anyone on that list, then you don't really have any business making offers on deals unless you're funding them yourself, right? So, and oftentimes, just depending on the structure that you do this, if you're syndicating this out, oftentimes they can be under a structure that's reserved for private relationships, right? I can't advertise this. That's a whole nother subject. There's other structures where you can. But frankly, someone sees an advertisement for a real estate investment and it's with an operator or a group that they've never heard of. Usually they're not investing, right? They're going to say, okay, this is more about the operator than it is the investment because, a bad operator can ruin a great asset, right? A great investment, and vice versa goes for them too. So anyway, that's where they should start really. As far as deal flow goes, they should be talking to a lot of brokers as well, and you can do that simultaneously. In fact, they're both in the same room at a lot of conferences and events, right? And so that's a great place to be.
So a lot of it is relationship building.
Yeah.
That's pretty much what I'm gathering. It's how you connect with other people.
It's a trust business too,
Yeah.
and not only just on the equity side, but on the brokerage side too,
Yeah.
right? A broker wants to know that you're not a tire kick, you're not wasting their time. You guys know, plenty about this, right? So, a broker wants to know that you're a real buyer. And I heard it once at a multifamily conference. Someone said, "How do I get the broker to sort of take me seriously?" And they said, "Well, your middle name is now Earnest Money, and you need to be putting down a lot of earnest money right up front, and that tells the broker that you're serious, right? Hey, I'm putting real dollars and my neck on the line here. I mean business, right? And so that's gonna move the needle for those guys. um, and investors, if you're starting out and you want to attract investor capital, you're not going to have a track record. So how do you get someone to trust you,
Yeah.
right? It's going to be some personal relationships, right? It's going to be someone saying, "Hey, this guy or girl has integrity, and I trust them to do the right thing." And I'll look at the investment if I think, you know, this person can handle this. I think they're smart enough to manage this asset. Um, that's great, but trust in this person comes first, right?
Yeah.
And so on top of that, you may also have to give up, some terms as well. Someone's going to say, well, I'm taking a new operator risk as an investor, right? And I've told other folks this too. They've come to me, hey, do you want to be a, limited partner in this deal? And it might be their first or second. And I'm saying, okay, what's the split? Well, I want to split it 70-30. Frankly, it's probably too aggressive for a first time operator. You might even have to give it all away. I don't recommend doing that, but I've seen some people do that where they go, I just want to get a couple deals under my belt. I want to get track record. And so, but I've seen 90-10 oftentimes used. Hey, as a sponsor, I'm going to do all this work. I'm going to make a minimal management fee. It's not going to pay all my bills, but a little something along the line, and then I'm going to take a very small slice of that profit. Because frankly, that investor partner is going to go, well, if I'm taking that risk, it has to be worthwhile. And that's just how you have to build your track record. If you have several full cycle investments under your belt, or at least a healthy portfolio of assets that are performing, that are under management now, it's going to be a lot easier to get new investors. They're going to say, okay, I don't know you that well, but now I've seen the track record, and maybe they've talked to your, those investors in those first 3 or 4 deals, right? And said, okay, these guys say that, you've done well here, right? So, that trust curve is a little easier to overcome, at that point.
Mm. Okay. Well, thank you so much. You've given us so much great information, and we have a clearer picture of, what it takes to be an investor and what it takes for funding. Is there anything else you would like to share with us before we close out?
No, if anyone's interested in learning more about what we're doing, I'll just put my email out there. You can
Yeah.
reach me at drew@magcp.com. If you just want to learn more about our business, what we're doing, happy to talk to anyone who's interested.
Well, thank you so much, and we hope to see you again with more information. Thank you, guys.
Thank you.